It's been an eventful week, and in a week of moves in which the market does one thing, the situation develops, and then it changes in some instances. Obviously, that was not the case with Apple earnings today, but we saw with the Fed meeting yesterday, for most of that meeting, we were in the green. And then at the conclusion of that meeting, we were solidly in the red. And then that continued into today. Now, who knows about today? Maybe that had something to do with Apple earnings. Apple earnings coming in better than Wall Street's expectations, not as bad as feared. I get all of that. It's a tough situation in my opinion because the stock is near all-time highs, an all-time high that it reached in arguably the most speculative bubble of all time. We had cryptocurrencies, et cetera, et cetera, et cetera. It wasn't like a 10 or 15% increase from pre-COVID levels. It was a dramatic increase from pre-COVID levels. And not just in the stock price, but also in the earnings multiple, which implies a growth acceleration. And we're not seeing that growth acceleration now, but we're back at the same price as before. So it's quite a puzzling situation. But it's been a crazy market, and there's only so much we can do about that, unfortunately. So let's take a look at what we can do and take a look at what's coming up ahead of us. And what's coming up ahead of us is the jobs number. We saw what happened with ADP. This is a big jobs number tomorrow. The Fed has two mandates. Ensure maximum employment, which was previously defined as 5% unemployment. And despite their rate forecast, which differs vastly from the market's rate forecast of 80% or something, or a 60% probability of a rate cut by July, the Fed expects to be holding at the current level until year end. So the Fed expects to be holding at the current level until year end. They expect economic growth to slow, and they expect unemployment to stay below 5%, and the rate picture to stay what it is. You're seeing, we talked about the 2-year in the past, you're seeing the 2-year drop dramatically, and that simply makes no sense for the 2-year to be at one point today below 3.7%, with the federal funds rate technically above 5%. The Fed expecting to hold it there until the end of the year, and then to go to 4.5% by the end of last year. So that is what the Fed, with all reasonable probability, is going to do. But the market is betting against it, and it's betting against it for one very obvious reason, and that's the banking stress. The Fed has had 2 consecutive meetings that come after and shortly after some banking stress, in which the market expected a pivot or a pause, or that was at least the hope. That was certainly the pricing of the bond market. It's been a very difficult road for those of us who are listening to the Fed, but nonetheless, here we are. So we've had 2 consecutive Fed meetings of people thinking a pause or a pivot might happen, calling for rate cuts in the near future because of banking stress, and we've had 2 consecutive meetings of the Fed not pausing, but actually hiking and leaving the door open to additional hiking, not signaling to the market, okay, you can cool off here, this is maximum pain. Yes, Powell did adjust his reasoning for additional rate hikes, but that's not the only aspect of the tightening. There's another aspect of the tightening, and that is balance sheet reductions, also known as selling securities into the bond market. And when you sell securities and bonds go down, rates go up. So keep that in mind, that everyone's thinking, oh, they're going to pivot, they're going to cut to ease stresses in the bond market. No, they will cut at some point, but for a long time, probably more than 2 or 3 years minimum, they're going to be selling bonds into the market, and likely the biggest seller of bonds into the market after previously having been the biggest buyer. So we take 2 meetings after failing banks consecutively, having additional rate hikes, leaving the door open to possible additional policy firming. I'm going to leave it at that. I'm going to say I don't even think another rate hike is going to happen, honestly. I just think they're going to continue quantitative easing. and they're not going to cut this year. That's all I think. That's not what the market thinks. It's not what it's priced for, but that's what it thinks. That's what's allowing the multiples to stay high. That's what's allowing yields to fall down. The 2-year at below 3.7%. That's going to have to reverse, and that is going to affect stocks. So that's my opinion on that. But tomorrow, again, big day. We have Bullard. He previously spoke. He's the first member, at least I believe, that is scheduled in the schedule I could see, that is scheduled to follow up Powell. He was also the first member scheduled to follow up Powell last time. Shortly after that, the market, or after the last meeting, the market was not pricing in a rate hike at this meeting. Somehow the stock market managed to go higher. The yield market managed to not change, and the 2-year actually managed to fall. And somehow we still got another rate hike. So it's a very big situation of the market continuing to price rate cuts and more rate cuts, or more extreme, and sooner cutting. It's a very, very interesting situation. And it's been rough. It's been difficult. It's been hard to navigate because it's been such a market that doesn't want to stick with the fundamentals. You would expect Apple, you would expect mega cap tech broadly to adjust based on their growth rates. You would expect their multiples to come down based on the growth rates. However, Apple is trading up near an all-time high. And yes, I get it. It's Apple. I know it's Apple. I've said on many videos for many months before, this stretch year to date of Apple talk, where I've said I record these videos on Apple products. I use Apple products. I like Apple. I get it. But I am looking at the stock. The stock's expensive. I'm not going to buy it right here. I don't want to buy it. As a matter of fact, I want to short it, but I also have to be humble and mindful of the fact that the market is crazy and the market can remain irrational longer than you can remain solvent. So we have to keep all these things in mind. But at the same time, analyze the Fed and what they're doing. And the phrases don't fight the Fed. I get it. The market has been doing that, and the market has been winning. But we'll see what happens tomorrow with Bullard. So that's today's video, and until next time, peace out.